Here's what separates profitable overnight swing traders from those who blow up their account. It's not the signal nor the number that signal shows, it's the size of the position. Overnight, billions of dollars move through SPY, its stocks, and the markets in general as most of Americans sleep. In overnight swing trades, there are no stop losses. The market closes at one point at the end of the trading day and opens up at another the next morning. Nothing is protecting you in between. It's your position size, which is your risk control. If the market changes the mood or pressure overnight due to earnings reports or political comments or possibly news the next morning, a smaller position size is the difference between a small setback and an account blowing up. Day traders do have an advantage. A stop loss defines your risk, and if the market hits that stop loss, you're out. In other words, overnight, as far as you're concerned, the market doesn't move tick by tick. It moves by a gap, either up or down. And so you need to pay attention what that average gap is. Is it 0.2%? Is it 0.5%, 1%, based on the ETF or stock that you're trading? It's important to be clear-eyed about the risk you're taking overnight, no matter what you trade, if it's a leveraged ETF or it's a stock or options. Next, keep your risks consistent. Don't follow hunches. Understand what you're going to do in different markets. In other words, pay attention to the VIX, volatility, the gamma regime. These are things that will help you understand if you're going to use a hedge or you're going to have a larger or smaller position size, because you understand the risk with each trade. You're not just guessing. You can use tools like the VIX as, say, your position size dial. Your position size should be able to withstand multiple days of losses. There are many reasons why your indicator may or may not work. Again, like we talked about, it could be news, it could be a volatile time with lots of political comments or changes within a national crisis. It could be many different reasons. And you need to be able to handle losses day after day, even if your signal measures the pressure correctly. If things are regularly changing overnight, you need to make good decisions. And quite often, that is the size of your position, which probably shouldn't be more than 2% if you have a large enough account. And success quite often can lead to our tragedy, because if we're maybe risking 10% or 15% or even 5% overnight, but yet our signal is usually correct, when we do have those losing streaks, then we start to get emotional and we start to increase our position sizes, which leads us to blowing up our account even faster. So set that top limit and stick to it no matter what. Obviously, smaller accounts have a tougher time sticking to that 1 to 2% position size. But the fact is, the best traders, the ones that make it through the ups and downs, tend to only risk 1 to 2%. So as your account grows, definitely continue to decrease that position size until you're in a more comfortable range. In other words, you're setting your position size for the campaign over a year, not for a single night trade. At SPYtomorrow.com, 4 o'clock Eastern Time, we display our free up or down signal. But before that, head on over to SPYtomorrow.com and use one of our simulators. Go through the process. Get a kind of an estimation of what happens when you trade 1, 2, 10, 20% on an account. And you can see how these smaller position sizes actually, in a real world sense, keep you in the game for the long haul. Once a young new trader emailed me, and he was trying some overnight swing trading ideas. But he said he had a problem, and that problem was that he had lost about 30% of his account over those 3 weeks. That should have never have happened. The staying power is the real edge. It's not about finding one perfect trade. It's about hundreds of well-sized trades. I'll see you in the next video.